executed on the objectives we laid out over the last several years, strengthening the platform, improving earnings power, and positioning the company for higher and more durable returns. As we look towards closing out 2026, we believe we have a clear line of sight to stronger ROEs, higher EAD, and continued dividend growth. We have already raised the dividend in 4 of the last 7 quarters, reflecting the momentum we are building and the confidence we have in the trajectory of the business. We remain excited about the opportunities ahead and look forward to continuing to share our progress in the quarters to come. With that, I'll turn the call over to Nick.
Thanks, TJ, and thank you everyone for joining us today. The company remained active, rotating excess capital into home equity and non-agency credit, where we continue to see attractive risk-adjusted returns and strong demand across the capital stack. MITT is well positioned to continue to benefit from the growth of the non-agency residential mortgage market. As stated previously, home equity remains core to our strategy, and we believe this segment will provide the company with compelling opportunities as this residential housing segment's growth accelerates. It is worth noting that while year-over-year non-agency issuance has increased nearly 50%, the home equity segment has seen annualized growth of almost 150%. We expect our early mover advantage and continued market leadership to pay dividends well into the future as our partnerships deepen with the growth of the overall market. This quarter, the company successfully issued 2 securitizations with an aggregate balance over $750 million. In the third quarter, we expect to issue over $1.25 billion across 3 home equity securitizations, building on partnerships with leading home equity originators. We expect to be able to continue this growth while maintaining a disciplined leverage profile, as demonstrated by the modest increase in leverage quarter-over-quarter of just 0.1 turns, bringing the company's economic leverage to just 1.8 turns. Importantly, at these current levels, we have plenty of dry powder to continue to grow our asset base by using a combination of liquidity on hand or untapped financing, which we expect to be an important driver of additional earnings power. On page 6, we highlight the second quarter's performance. This quarter, there were modest net mark-to-market gains on our investment and hedge portfolio, despite the bear flattener and meaningfully higher nominal yields. Despite a challenging origination backdrop, at Arc Home was able to distribute $6.6 million in excess capital to MITT during the quarter, while growing origination volumes and making early progress on newly launched home equity offerings. This, combined with the previously mentioned capital rotation, drove the company's earnings power. Following TJ's remarks regarding the status of resolving the legacy commercial portfolio, we look forward to quickly rotating that capital into attractive opportunities within our core strategy to drive meaningfully accretion to EAD. To reiterate TJ's remarks, we see approximately 20 cents annual EAD pickup in aggregate, with this improvement beginning in the third quarter and accelerating through 2027. Before handing off the call to Anthony, I'd like to comment briefly on MITT's strategic acquisition of Cherry Hill Mortgage Investment Corporation. As TJ noted, this is a highly complementary portfolio. Cherry Hill's mortgage servicing rights will provide MITT with a new revenue stream that delivers additional diversification to the existing portfolio. We are confident that this is another segment of the broader residential mortgage ecosystem that MITT is well suited to leverage in the future to generate attractive risk-adjusted returns, and importantly, will contribute to earnings immediately. Additionally, we believe that the combined balance sheet will provide opportunity to free additional capital through opportunistic sales and additional leverage capacity. Over to you, Anthony.
Thank you, Nick, and good morning, everyone. During the second quarter, we continued rotating capital into home equity loans and non-agency securitizations, successfully executing 2 co-sponsored deals. We also gained significant momentum towards resolving certain of our legacy WMC commercial loans and delivered continued strength in earnings available for distribution, or EAD. During the quarter, book value increased 0.3% to $10 per share, generating 2.7% economic return inclusive of our 24-cent dividend. GAAP net income was approximately $9.1 million, or 29 cents per share. Net income during the quarter was driven by durable EAD across our investment portfolio and Arc Home, hedge-adjusted gains on residential investments, and unrealized gains on legacy WMC commercial loans, supported by $3.5 million of payments received, which reduced our cost basis and were used to continue delevering these investments. Our investment portfolio continued to generate high-teen ROEs while expenses remained controlled. We recognized EAD of 24 cents per share, fully covering our dividend. Net interest income, inclusive of our hedge portfolio, was 65 cents per share, exceeding 45 cents of expenses and preferred dividends to generate net earnings of 20 cents per share. Our COM contributed an additional 4 cents per share to EAD, consistent with last quarter and driven by origination volume growth. Our investment portfolio stood at $7.7 billion, primarily allocated across high-quality, agency-eligible, non-QM, and home equity loans. While headline assets declined from $8.1 billion in Q1 due to securitized loan paydowns, our Q2 securitizations deployed capital into unconsolidated non-agency RMBS rather than consolidated loans. During the quarter, we purchased an additional $70 million of HELOCs ahead of a planned Q3 securitization and acquired $38 million of non-agency RMBS through executing 2 partnership deals without incurring warehouse financing risk. Looking ahead, resolving non-accrual commercial loans unlocks roughly $30 million of capital for reinvestment into higher-yielding residential investments, further enhancing shareholder returns in 2027. Rounding out a strong quarter, we're excited to execute on our strategic acquisition of Cherry Hill, delivering immediate and long-term benefits to shareholders of both companies. The transaction is expected to drive EAD accretion in 2027 by acquiring a portfolio generating attractive equity returns while realizing significant operating synergies upon combining the platforms. Cherry Hill's agency RMBS and low WAC MSR portfolios bring durable, predictable cash flows that complement our residential loan strategy, strengthen our net interest margin, and provide strong support for our dividend. Importantly, this transaction achieves scale through permanent capital without adding unsecuritized debt, supported by a significant contribution from TPG and an amended manager incentive fee structure that aligns interests with shareholders and TPG's commitment to growth in MITT's pure-play residential strategy. Upon combination, pro forma economic leverage will settle at approximately 2.9 turns, de-risking Cherry Hill's historical profile while maintaining our conservative balance sheet relative to peers. As we ended the quarter with $112 million of liquidity, funding MITT's $15 million of cash consideration leaves us with ample post-close flexibility to capitalize on a larger, more liquid platform. I'll now turn the call back to TJ for closing remarks.
Thank you, Anthony. I'd like to close by addressing Cherry Hill shareholders. We hope you agree that this pending transaction is compelling and should deliver long-term value for you. We look forward to welcoming you to our combined company, and we sincerely hope your ownership continues. And with that, we'll open up the line for questions. Operator?
Thank you. If you'd like to ask a question, press star 1 on your keypad. To leave the queue at any time, press star 2. Once again, that is star 1 to ask a question, and we'll pause for a moment to allow everyone a chance to join the queue. And once again, if you'd like to ask a question, please press star and 1 on your keypad now. And I'm showing no questions at this time. I'll now turn the program back to our presenters. Oh, apologies. We do have a question. We'll take our first question from Bose George with KBW. Your line is now open.
Hey guys, good morning. Actually, first on the acquisition, is the plan to maintain that portfolio, both the MSR and the agencies as is, or any thoughts on how that might look as a combined company?
Good morning, Bose. This is Nick. Thanks for the question. So similar to all of our strategies, we'll optimize over time. There is an expectation that there are portions of the portfolio that will be retained and others that will be rotated, not dissimilar to sort of our current strategies.
So, okay, great. And then actually, in terms of the mix of the different assets, leaving aside the acquisition, what, like, how do you see that evolving? Do you see home equity as being a potentially much larger piece, or just how do those pieces potentially look a year out from now?
Yeah, the expectation is, from the prepared remarks, that home equity will continue to accelerate. We just currently see, a competitive advantage and more relative value there. So I would expect that to continue to grow.
Okay. And the returns there have they remained fairly stable? It seems like there's, a lot of activity in that space, a lot of production, but you feel like the returns are relatively stable?
Yeah, look, I mean, generally the market has gotten more competitive, in non-agencies broadly. This segment itself is not isolated from that, but we do believe it is generally more isolated than other segments for various reasons. And, it's our view that we have a strong competitive advantage to drive higher returns there relative to other segments.
Okay, great. Thanks.
Thank you. And as a reminder, if you'd like to ask a question, you may do so by pressing star and 1 on your keypad now. And I'm showing no additional questions at this time. I'll now turn the program back to our presenters for any additional or closing remarks.
Thank you, everyone, for joining, and we look forward to speaking with you again next quarter. Have a great day.
Thank you. This brings us to the end of today's meeting. We appreciate your time and participation.